One of my largest and most successful investing positions has been Apple. I hold two of the big tech companies, Microsoft and Apple. Now, these might seem like obvious picks, but I've held Apple for over 5 years. My first purchase of Apple was back in December 26th of 2017 for a share price then of $170, but it's gone through a stock split. At the time, it was trading at $42 per share. So Apple stock has increased over 4 times since this first purchase. My investing thesis for Apple was very simple at the time, and it's largely the same then that it is now. Apple has an avid customer base that loves the product and a dominant ecosystem that keeps customers in their product base. Now, over this past 5 years of owning Apple, I've watched this company closely. I've become very familiar with the challenges that it faces. One of the challenges that Apple commonly faces is the challenge of China. This has been a constant question mark for Apple over the years. We have Apple right now trading down significantly today and yesterday over concerns of a China ban. Apple shares are trading lower amid reports that China is expanding its ban on the use of iPhones to government-backed agencies and state companies. This has dropped the stock 3.25%, and then over just the past 2 days, the stock is down 7%. So we have almost a correction in the stock, almost down 10% over this news of a China ban. Apple's relationship with China is so meaningful, it's such a big part of the company, that when there's any threat to it, major news corporations like the Wall Street Journal and the New York Times, they publish articles covering this news. Apple's symbiotic relationship in China faces new questions. So we're going to see what those questions are, and I'll be going over if this is a legitimate concern for the Apple shareholder. Now, we also have some other news we're going to be covering. Warner Brothers Discovery says ongoing strikes, the writer's strike and the actor's strike, will mean $300 to $500 million hit in 2023 earnings. So we'll see how this is going for both Warner Brothers Discovery and Netflix. We have news that the FTC is imminently close to suing Amazon, and this is the big one. This is Lina Khan's last stand, her giant lawsuit against Amazon. She wrote papers way back in 2017 about how Amazon is so good at skirting antitrust laws. That's what made her popular, what made her famous. And now she's in a position to actually sue Amazon. So we're going to see this standoff between the FTC and Amazon. I'll be giving you a breakdown of who I think has the better hand. And then finally, he's back. Anytime the market seemingly drops a few percentage points, Jeremy Grantham ends up in an interview that gets a ton of attention and views. He's one of the biggest bears. In fact, I would say he is the biggest bear today. He's predicting doom and gloom in the market. He says that we're in an epic bubble, seismic proportions. And of course, we're going to be covering this interview. Now, as always, we have a lot to get into. Let's go ahead and start off with the news of the Apple China ban. This story was exclusive from Bloomberg, and we have Mark Gurman, who is one of the analysts that covers Apple. And he's also notable for always having the inside scoop on Apple. He always has leaked information.
Yeah, this situation is quite interesting because about a year and a half ago, this ban on having foreign devices, having US-made devices within the Chinese government workplace, right, that ban was announced. It was something that they wanted to phase out within 2 years as of a year and a half ago, right? So to me, it's not necessarily a surprise that they're implementing this ban on iPhones, and there's also other foreign devices banned too. Obviously, Samsung, those are made in Korea. The Chinese government probably wants to use, their homemade devices, Xiaomi, Huawei, Oppo, right? Asus, you name it.
So there we have some nuance to the situation. This wasn't a targeted ban on Apple. 2 years ago, the Chinese government decided they wanted to secure their government positions, which means they didn't want foreign technology as part of their government positions. This includes any foreign maker of phones. So any non-Chinese maker of phones, including Apple and Samsung, are not allowed in Chinese government positions. So the policy seems more reasonable and less targeted towards Apple. But this generated a strong headline opportunity for the news organizations. News organizations like the New York Times and the Wall Street Journal don't really live for nuance and context. They live for headlines. Just from the headline, what investors are reading here is that the Chinese government has become increasingly aggressive towards Apple, and that is cause for concern. When you read headlines like this, of course Apple's selling off. It makes you think that the Chinese government's going to outright ban Apple from the country. But when you dive into the actual story, you get a little bit more nuance. China ordered officials at the central government agencies not to use Apple's iPhones and other foreign branded devices for work or bring them into the office. That second part of the sentence is the important part here. This was not a target at Apple. They are saying that any foreign device outside of a Chinese-made phone is not allowed in government positions. It's reasonable and logical for the Chinese government to be wary about foreign-made devices in their government positions. The US government has had the very same concerns with foreign-made devices in their government positions. The US banned the new Huawei ZTE equipment sales, citing national security risk. TikTok was recently banned from any government device, despite the TikTok CEO doing everything he could to ensure the US government that he was abiding by all the US regulations, even offering to host TikTok data on Cisco and AWS servers. It still wasn't enough. The US government was so concerned about TikTok that they banned it off of government devices. When you actually compare the different government reactions, China's is less targeted than the US's. The US's is specifically targeted at Chinese devices, while the China ban is targeted at any foreign device. So to get this straight, while the news sources are putting Apple's name in the headline, this is an untargeted ban on any foreign device, and this has been talked about for years now. This isn't new. This is something that governments are doing to ensure that their data doesn't fall into the hands of other countries. And it very similarly mimics the things that the US has done in the past. And there's an argument to be made that this is less targeted than what the US has done to China. Now, of course, this does open up a few more questions. If China's banning any foreign device from government positions, how much will that impact Apple's sales in China? And what does this mean for the future of Apple in China?
Yeah, I don't think it's a significant or material amount. I don't think the investor concern over this development is so much lost sales to Chinese government customers. I think people concerned is there going to be a domino effect. First, it's the Chinese government that doesn't want their employees using these devices. Is there something that's going to happen next in terms of the Chinese consumer being able to buy the Apple devices? Are there going to be limits there? Is the Chinese government going to begin clamping down on Apple's ability to sell, offer services, offer retail stores, offer Apple Care and support? Right? So there clearly is a potential domino effect that I think investors are more afraid of rather than just lost sales to Chinese government workers.
If we look at Apple's revenue, around 19% of it comes from China. So we can assume that around 19% of their iPhone sales come from China. Now, this ban in particular is only impacting Chinese government positions. It's not impacting the average Chinese consumer. Now we can see how this breaks down. We don't have the official numbers, but we have the estimates from analysts. They estimate that Apple sells around 45 million phones per year in China. And of those 45 million per year, around 500,000 of them go to Chinese government officials, which means that less than 1% of sales in China are to government officials. So mathematically speaking, this should have around a 0.2% impact on Apple's total revenue. So what we know right now by the facts is that Apple is down over 7% over the past 2 days on news that the revenue may be impacted by up to 0.2%. Now, of course, this is how the market works. It's not based on mathematical probabilities. Investors trade based off emotions and fears. And right now, these headlines create big fears. What happens if Apple is banned outright from China? What is the Chinese government going to do next with Apple? There's always a chance that the Chinese government could become more hostile to Apple. There's always a possibility of that. But the Chinese government has benefited greatly from Apple's presence in their country. The estimates way back in 2019 were that Apple was supporting more than 5 million jobs in China. And this is a country that needs good jobs. They need to grow their GDP. The real estate market in China is doing very poorly. So Apple supporting millions and millions of jobs in China is something that they must value as an economic benefit. So it is possible for the Chinese government to outwardly ban Apple from all of China. Of course, that fear does exist, but the Chinese government would be biting the hand that feeds them. Apple creates millions of jobs for China. If China bans Apple, those jobs go away. And I believe overall, the probability of an outright ban happening as of now is very low. So as far as I'm concerned, I'm going to continue to hold Apple. I've been through these type of fears and challenges with this company many times in the past. Peter Lynch has stated that buying great companies is easy, but not getting scared out of them is difficult. If you're going to get scared out of a company like Apple, anytime you see this type of headline risk, then you're not going to be holding these great companies for long. Now moving on, we have news of the writer's strike and the actor strike continuing to hurt Hollywood, filmmaking, and the streaming companies. Warner Brothers Discovery says the ongoing strike will mean $300 to $500 million hit to its 2023 earnings. The CFO of the company said that uncertainty in the studio segments has increased with the dual strikes. This may have implications for the timing and performance of the remainder of the film slate, as well as our ability to produce and deliver content. And while we are hoping for a fast resolution, our modeling assumes a return to work date in early September. Should the strikes run through the end of the year, I would expect several $100 million of incremental upside to our free cash flow guidance and some incremental downside to our adjusted EBITDA. The way this works is their earnings and EBITDA are going down, but their free cash flow are going up. The free cash flow is going up because they can no longer spend money on creating content. Now, when I look at the impact that this writer strike is having on the industry, it's delaying a lot of content, pushing things further back, and making it so that the content slate of many of these streaming companies has become very stale. For example, we have Dune 2. This was a major blockbuster movie that was supposed to be released this November, and they recently pushed it back to 2024. They want to be able to promote the film. They want to have their actors go and do interviews and talk on late night shows and do things where they can get exposure. But since the actors are under strike, they can't do any promotion of the film. So this film's being pushed back until the strike ends. And that's making it so a lot of these streaming companies are running out of content. Netflix still has a huge pipeline of content that they're releasing, but Warner Brothers Discovery, Paramount, and Disney are struggling with content right now, and you can tell by visiting their libraries. They're not changing that much. I believe the big winners of this are TikTok, YouTube, live sports, and video games. While the streaming services are running dry with content, Apple TV with their MLS Season Pass is going full steam ahead. They're gaining more and more subscribers and more people interested in sports. Many people are turning to YouTube to watch more content, watching more podcasts, and doing things outside of turning to their streaming services. So I believe the longer this strike goes on, the worse it is for the entire industry. Now moving on, we have news that Apple's not the only company that's getting in trouble with government agencies. We have Amazon, which is going to have a lawsuit launched against them from the FTC. And it is imminent. This is going to be happening very soon. In fact, they expect this next month. So you're going to see breaking headline news that the FTC is launching a massive lawsuit against Amazon to call the company a monopoly, an entrenched market leader that has used monopolistic techniques to block out competitors, and that ultimately Amazon needs to be broken up into little pieces. Now, this is happening because of someone named Lena Khan. I've talked about her frequently, but she's the FTC chair, and she has a bone to pick with Amazon. Back in 2017, while she was in school, she authored a paper called Amazon's Antitrust Paradox. The paper made waves in the antitrust community because it argued that the modern application of antitrust laws has failed to capture the ways the tech giants like Amazon are able to dominate in the digital world. So she's saying that Amazon was able to circumvent or to go around all of the antitrust laws and become a big monopolistic company. Now, this was part of the reason she was actually picked as the FTC chair, was because of this paper. So the government selected her because of her bias against Amazon and her previous thoughts on Amazon. Now, Amazon and Apple and Microsoft have all argued that that should disqualify her from being in the FTC position. So they've pushed back on that, saying that she is basically biased against the companies, and she's not trying to apply the law as written. She's trying to apply her own version of the law. So there's a big disagreement in the way that antitrust law should be given. But either way, it is what it is. She is the chair of the FTC, and she is coming after big tech. And this challenge to Amazon's alleged monopoly could have major consequences for the company. It could result in a trillion-dollar business being broken up into parts. That is what she's going for, a breakup of the company. So what do I think are the possibilities here? First of all, as always, there's a chance that anything could happen in court. Court's a little bit unpredictable. But when it comes to a company as big and meaningful as Amazon, this is one that the government is going to take very seriously. This has major implications on people's lives. And I believe this is going to be a very difficult case to argue for the FTC. A couple reasons this will be so difficult. The first thing is that Amazon does offer a ton of value for customers. Having 2-day shipping is incredibly valuable. Prime members love Amazon's 2-day shipping. So anytime a company offers a lot of value to customers, something that they're really attracted to, that's difficult to argue and break up. If you jeopardize customers' 2-day shipping, that could make people furious at what the government did. Another point that's going to be difficult is Amazon is a huge employer. They employ over 1.5 million people and they pay above average wage. So you're arguing against a company that consumers love and it employs a lot of people at higher than average wages. Another point that Amazon can argue is that most antitrust law looks kindly upon companies that reinvest all of their earnings back into the country. They want companies that put major investments back into the US. Amazon is one of the biggest investors in the US, putting tens of billions of dollars per year into infrastructure, into logistics, into expanding their network. Not many companies are able to reinvest back into the US, and a lot of companies, they reward shareholders with buybacks and dividends. Amazon's not doing that. Amazon is an investor in the US. So I see it as a very difficult task to try to break up a company that provides tremendous value to customers, employs 1.5 million people, and does major investments within the US. Messing with this formula and potentially screwing up a company that has accomplished this, I think is a very risky thing for the US to do. So I believe that Amazon has by far the better hand here. Now it's time to check in on the biggest bear in the market, and that is Jeremy Grantham. He's one that always seems to be bearish on the markets, but he recently just had an interview with David Rubenstein, and this interview he goes over his case once again.
Throughout his 5+ decades managing money, Jeremy Grantham has earned a reputation as a bit of a doomsday oracle. The billionaire co-founder of GMO has become famous for predicting financial disaster, most notably by identifying investing bubbles before they pop, like the dot-com crash in 2000, the financial crisis in 2008, and the tech bubble in 2021.
Let me pause right there. What they do in the introduction here is they highlight some of the biggest bubbles that Jeremy Grantham has accurately predicted. He did predict the 2001 bubble, he did predict the 2009 bubble, and he did predict the 2021 bubble. That is all accurate. So this is technically correct. This isn't misinformation, but the truth lies in the details. Selective truth is still untruth in many cases, and what you see here is selective truth. While it is true that he predicted all of these bubbles, he also predicted many bubbles that never existed. One of the biggest bearish calls that Jeremy Grantham has made was in 2010. Here's Jeremy Grantham, November 11th, 2010.
Is we don't like to play games with overpriced assets. And that's the world that we're in now. The Fed is driving the S&P, which is overpriced, the Standard & Poor's 500, a broad measure of the US market. It's driving it from already substantially overpriced into what I would call dangerously overpriced. This is about the boundary line. We expect on the 7-year horizon 1% only plus inflation from the US market.
This is the point in the S&P 500 where Jeremy Grantham said that everything was overvalued and we'd have no returns. So to revisit this, sure, it's technically true that he did predict all 3 of these crashes, but this is textbook survivorship bias, only highlighting the times he was correct, ignoring all the many times his calls were wrong. So the accuracy is questionable. Jeremy has gotten it wrong before, but maybe he's correct this time. Let's go ahead and listen to his take on the current tech bubble.
I think we are descending from the 2021 bubble, which was one of the great bubbles. And this should be normally the deflationary period, the deflating period, which is a function of will the earnings decline, will profit margins decline, will the economy go into recession, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
The recession is something that most bears are predicting at the end of this year and the beginning of next year. That's the timeline that they've given. But if you rewind 2 years, the timeline they were giving was the end of 2022 and the start of 2023. We're supposed to already be in the recession. The pesky, annoying thing for the bears is that the recession doesn't seem to be happening. The data continually comes in a bit stronger than expectations. And since there's no recession happening, they have to push back their timelines of their bearish predictions.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't really project a recession any longer.
Right.
You disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles. They prided themselves in stimulating the bubbles. They took credit for the beneficial effect of higher asset prices on the economy. They have never claimed credit for the deflationary effect of asset prices breaking, and they always do.
Now, he calls into question the record of the Fed. The Fed has always gotten it wrong, and they never call recessions. Well, of course, the Federal Reserve is not going to go out and say, we're expecting a recession next year. That's not something that a government official will ever say, because that induces fear, which makes it more likely to cause a recession. So that critique of the Fed is a little bit absurd. Of course, the Federal Reserve is not going to be predicting recessions and speculating into the future. They give probabilities, and the Fed has said there is a probability of a recession or a slowdown, but we don't think that that's the likely path based on the data that we see. The other thing to note here is that Jeremy Grantham is questioning the record of the Fed without even looking at his own record. How many calls has he got wrong over the past decade alone? He said the market was deeply overvalued in 2010. If you listened to Jeremy Grantham's advice back then, you would have missed out on the best bull market over the past 50 years.
You said not too long ago that you weren't a big fan of Jay Powell and the way he's been handling inflation. Is that correct?
Yes, that's correct.
And you think he's done a better job recently in getting inflation under control?
I think it's largely out of his hands. The forces work. I suspect inflation will never be as low as it averaged for the last 10 years, that we have re-entered a period of moderately higher inflation and therefore moderately higher interest rates. In the end, life is simple. Low rates push up asset prices, higher rates push asset prices down. And we're now in an era that will average higher rates than we had for the last 10 years.
I think this is a sound point by Jeremy. It is true that if interest rates go up for a longer period of time, asset prices have enormous pressure. Buffett has talked about this effect as being like gravity. Interest rates go higher and it pushes down everything else. Now, in terms of inflation never going back down to 2% and being stuck at 3%, Jeremy never really explains why. Why is inflation stuck at 3% instead of 2%? Now, the next question that Jeremy's asked is one of human nature and why people are drawn to bubbles. Why this is a mistake of humans that we make continually and will continue to make in the future.
Why is it that humans can't resist being in bubbles?
I always like to say there's nothing more supremely irritating than watching your neighbors get rich. It is just irresistible to try and join in. And when enough people hit the inflection point, it sucks in everybody. And they're the great bubbles. They're the ones that are interesting. Mostly there's a nice balance between bulls and bears. And once in a blue moon, every 20 years or so, you'll hit an inflection point where enough people become bullish that people stop thinking about fundamentals.
Jeremy is spot on here, and he does know the mechanics of how a bubble forms. Bubbles form by people doing what's called social proofing. Something that other people are doing becomes the norm, and because enough people do it, it becomes widely accepted. It becomes normalized amongst the investment community. So many people doing something ensures that you're not the odd man out. You don't feel like you're doing something wrong if you're doing what everyone else is doing. And in fact, you feel wrong by not doing what everyone else is doing. You feel like the odd man out. If everyone is investing a certain way and you're the only one not investing that way and everyone else is making money investing that way, that creates an enormous amount of pressure to invest the way that everyone else is. So that's where you get massive bubbles like the one in 2021, the one in 2007, the one in 2000. It's by social proofing and peer pressure. So many people doing something and it's normal human behavior to follow suit. The excellent investors, the ones that can avoid this, derive no pleasure by being with the crowd. And those are investors that have this unique trait, almost like they're born with this unique human trait of not caring about fitting in. Warren Buffett never cared about fitting in with other investors' behavior, and he knew that people would get excited about stocks and drive up prices. He's also accurate in saying that when enough people become bullish on something, when there's that peer pressure and social proofing, they forget about fundamentals. We saw this in 2021 with many of the tech companies. People threw the fundamentals in the garbage and they looked to stories about the grandiose future of these companies. Many of them that had incredibly poor fundamentals, generated no cash flow, had very dubious business models. They were unproven companies, but people forgot about it because overall, everyone was bullish. This is why I'm constantly looking at the fundamentals of companies. This data is real. This data is not hypothetical. This is what's really happening with the company. This is the true valuation, the true facts of a company. This keeps you grounded and anchored to rationality. When you find yourself not caring so much about what the numbers say and only attaching to stories, that's a recipe for disaster. Now, I've recently been reading a book called The Psychology of Money, and it's a great book. I'll put a link to it as well as other recommendations in the description below. But in The Psychology of Money, one of the points that's made is that many people invest based off of how they're raised. It's not so much about what the data says. It's not so much about history or the study of history. People invest based off of their own unique experiences. For example, someone that grew up during the Great Depression is going to have a very different experience in investing than someone that grew up in the 70s. The psychology of money is that people make investment decisions based on their own unique experiences. And what Jeremy Grantham experienced early in his career are huge bubbles in the market.
And we owned small stocks as well. And small stocks were not fashionable. It was the Nifty 50 era where everyone owned Avon and Exxon, and that was it. So it was very unfashionable to own cheap, small companies.
Early in his career, he avoided one of the biggest bubbles called the Nifty 50. The Nifty 50 was a group of companies that were considered indestructible. A lot of people equate them to modern-day big tech. The difference was that back then, the Nifty 50 was trading at extremely high valuations, 50+ forward PE ratios, so they had a decade of incredibly low returns. And Grantham worked during a time where he avoided that massive bubble. So he's made a lot of money by avoiding what the common investor has done. And these past experiences shape how he views the world.
And of course, they were much, much cheaper. And in the long run, that means you do better. And we had a hard job selling the idea to a world whose idea of heaven was IBM and Coca-Cola. But eventually, we made some penetration.
Now,
So Jeremy Grantham has been in this career of predicting bubbles for a long period of time. And I think this is a very difficult way of investing. You can make money doing this, potentially, but I'd much rather go the route that Warren Buffett has, where you're aware bubbles will happen, you try not to participate in them, but you also stay long the market, buy good companies at reasonable valuations, you don't get swept up in mania and overvaluation, and you hold on to companies that can make it through recessions. That strategy in investing is far more appealing to me. Currently, I believe there's pockets of the market that are still overvalued, but when I do analysis on my portfolio, I compare the valuations of my companies, my future estimates of their free cash flow, and I compare that against historical averages. I do not believe any company in my portfolio is overvalued. So as of now, even with the warnings of Jeremy Grantham and others, I'll remain invested. And I am fully confident that if we go through a recession, these companies will make it to the other side. So I hope you enjoyed this episode. If you did, make sure to subscribe to the channel, leave a thumbs up, and I'll see you in the next one.